is our final session for the day. For featuring more insightful research perspectives, I invite the chair, Professor Anindita Chakraborty from IIT Kanpur, to lead our session. First, of the last set of papers for the day, I invite Ms. Gunjan Khandelwal from Shyam College and Mr. Dibyendu Maiti from the Delhi School of Economics for their paper on gold savings and investment behavior.
So we had a real thought-provoking panel, and we have a set of 5 very interesting papers. So please make your presentation. There is not much time keeping. I have to do, the beeps. Yeah. They will go off. Yeah. Sure. Please.
So very good evening to everyone. A very good evening to everyone. My name is Gunjan. I'm working as an assistant professor in University of Delhi. I'm a PhD scholar at Delhi School of Economics. So this paper is a joint work under the supervision of my supervisor, Professor Dibyendu Maiti. The topic of my paper is gold saving and investment behavior of Indian households using the IGPC price data set. So as we know that India is the second largest consumer of gold after China, the amount of gold requirement majorly is catered by the imports, and there is a lot more impact on the current account deficit because of that. So there's need to understand, the requirement is there for the knowledge of household saving and investment, how the household saves and invests in gold across different gold products. So my paper is based on the quadratic age estimation, wherein I tried to estimate the expenditure elasticities across the different gold products using the IGPC price data set. So moving on with what has been worked on this topic so far. There has been many studies regarding how the gold has performed over the years. It has worked as a safe haven during the financial crisis. There are papers which talk about that there is higher demand for gold after the COVID as well. And there are papers which are also talked about the price and the income elasticities of gold. But and majorly it has been the gold import demand. There is one paper by Mukherjee and Das in 2017 which also talks about the price and income elasticities of physical import of the gold. But there are very few or limited number of papers in my knowledge which talks about the elasticity of gold in terms of different gold products. So when I say different gold products, it means the physical gold as well as the paper gold. So physical gold includes the jewelry as well as the coins and bars, whereas the paper gold includes the gold ETF, SGBs and the digital gold. So before I move on to that, the data that I have used for my analysis is the IGPC price data set, which is a biannual household survey, which captures the saving and the investment behavior of the households, how do they invest in different gold products, and keeping into account the demographic characteristics of the households, also the consumer sentiments and the expectations. So moving on with some graphical analysis. The first two graphs, if we see here, it is the average amount of gold that is being invested in the different gold products. So as we see that there are 5 bars that we can see here. In the first graph, if you see, the highest bar depicts for the jewelry consumption. So it is for the jewelry. The second is followed by the coins and bars. The third is SGB investment amount. And fourth is the ETF. The fifth is followed by the digital gold. So so what we can see here is that there is large amount. The average amount invested in the gold jewelry is the highest, followed by the coins and bars, and then it is the approximately same for the ETF, SGBs and digital gold, and the last is the gold ETF. The difference between the two graphs is the first graph talks about, it only considers the household which have invested at least in one of the gold products. However, the second graph considers all the households on average. I have also, so next it is in terms of numbers, wherein what is the average investment in the different gold products across the different income levels. So now here if we see that again, majorly it's the amount invested in the gold jewelry is the highest, followed by the coins and bars, which means that there's higher demand for the gold jewelry in the physical form, followed by the paper gold. And that is more major, the gap is more wider in case of the lower income households, which is in the range of 1 to 2 lakh to 10 to 15 lakhs. And then this gap actually declines as the income level increases. Now, the third graph that is there is the gold investment across the different income levels. So here, if we see that there is the, when in the lower income bracket, where you see less than 50,000 income levels, see here we have 5 kinds of graphs. Again, 5 bars here depicts the different 5 gold products, and the last one here represents the expenditure on the other goods. So if you focus on the figure 3 of the first bar, which is less than 50,000, here the average amount invested in the jewelry is actually higher than the routine expenditure that the households make, which in turn means that they spend more than what they spend on the routine expenditure, which includes the food and the non-food consumption expenditure. So now this could be explained with the Veblen effect or the conspicuous consumption, wherein the lower households, they try to buy the jewelry or the coins and bars majorly in order to maintain their social status, or to show maintain the status in the society. However, if you see over the higher income brackets, the jewelry demand, the average investment in the jewelry is actually lower than the routine expenditure that is there. Then the next kind of graph talks about the gold investment across the occupation groups. So here majorly the one point that I want to make here is the only non-agricultural labor. When it is the non-agricultural labor or the agriculture sector, there again the gap between the investment in the physical form and the paper form is actually wider than the occupation where it is the public sector or the private sector. Then across the different education levels also I have tried to estimate. So this is it, but I'll move on to the next part. Conceptual frameworks, then I have tried to form a theoretical model here, wherein there is 2 kinds of goods we need to focus on: consumption goods and physical goods. So I have defined the utility function here in terms of the intertemporal expected utility function. Also I have explained, so there's this so there is this budget constraint which has the one of the good is the consumption, regular consumption good, the other is the physical gold consumption, and the third is the DT, which is the gold interest bearing gold. So using the Lagrange method, I've tried to estimate what is the demand for physical gold, and majorly, so if you see this GT in turn depicts the demand for the physical gold in terms of the gamma and the interest rate. So interest is the interest that we earn on the digital gold, and gamma is the preference that is there towards the physical gold. Now that could be because of the in terms of the physical gold. If we keep physical gold, then that is better for the adornment purposes. So then gamma that represents that part. So the result is that the demand for the physical gold, it is directly related to the preference that they have for the physical gold, and it is inversely related to the interest rate, which means that as the interest rate increases, the demand for the physical gold will fall because they prefer to invest in the digital gold in that case. So then the next part that I have kept is the quadratic age model, wherein I've tried to estimate the expenditure elasticity. So this is the equation that I have followed, which is the shares is in terms of the log income upon the Cobb-Douglas aggregators of the individual prices, keeping into account the homogeneity and the Slutsky symmetry conditions. So moving on to the results, expenditure elasticity basically here means that how does the demand or what is the responsiveness of the households as when their expenditure or the actual spending increases. So how does the demand for a particular gold product change with respect to the 1% change in the actual consumer spending. So this I have done across the income levels. So I have bifurcated the households in terms of 2, wherein the first table talks about the low income households, which have income level less than 3 lakhs, and then the high income households which have income greater than 3 lakhs. Now here the expenditure elasticity is all positive, which means that as the actual spending of the households increases, the demand for the all gold products increases on average, which is positive. But then the value, the difference is in terms of the magnitude. So here in the low income households, the magnitude of the elasticity is higher for the jewelry and the coins and bars, whereas the magnitude of elasticity is higher in case of gold ETFs and digital gold in case of high income households. Now this could be explained with the fact that low income households are more responsive to the changes in the, so they prefer more towards the physical gold, which is jewelry and coins and bars, and the high income households, when their actual spending increases, they prefer to move to the SGBs, gold ETFs and the digital gold. Similarly, I have also done this expenditure elasticity quadratic age estimation with respect to the education level. So again, less educated households, so three tables here. Less educated households are the ones which have, so here the households, less educated household means the chief wage earner in the household is less educated. So less educated here means that it is he is educated up to the primary level, moderately educated households up to the secondary level, and highly educated households are the ones where the chief wage earner in the household is graduated and post-graduated. So here again the value of the elasticity is positive, which means that the actual spending leads to the increase in the demand for all the types of golds. But then with respect to the less educated households, the amount of the magnitude of the elasticity is again higher for the jewelry and coins and bars. And then with respect to the moderately educated households and the highly educated ones, they have more the degree of the responsiveness is higher for the SGBs, gold ETFs and the digital gold. So here this paper talks about how the responsiveness of the households have been across the different gold products. Now this could also be extended. Now the extensions of the study could be there could be long run or short term elasticities that could be figured out, in the sense that I had only one financial year data, which is for 2022 and 23. Now if we have more data, then I can also move on to the long run. I can also compute here long term elasticities and short term elasticity. And then also there could be cross price elasticity. We can understand that how 1% change in the price of one of the gold products leads to a change in the quantity demanded of the other gold product. Similarly, there is we can also here move on to compensated and uncompensated price elasticities. Also the robustness check could be done, and the extension of the conceptual framework can also be done. So here in the last part, when I had discussed about the conceptual framework, I have taken the easiest here. The assumption that I have taken is very simplified here, that is the lump sum tax, and then that could be varied, and then this could also be extended further. So yeah, this is it. Thank you.
Yes, thank you very much, Gunjan. Very interesting paper. I would just like to, can I just have a comment and then I throw it open for questions. When you said that the lower income group, they were using the gold as a sign of conspicuous consumption, and you draw on Thorstein Veblen's work, I would like you to be a little more careful, because conspicuous consumption cuts across the different strata of society, right? And that we have seen in social media and the weddings. But traditionally, a lot of communities were not allowed to use gold. And tribal communities, they use silver. And there is a sociological concept of Sanskritization. So they emulate the ways of the upper caste, upper class. And therefore, they would be like the tribal communities, I know for sure, like instead of buying 1 kilo of silver, now they're buying 10 grams of gold. So there is a behavioral change across different social groups. So maybe you can sort of, bring it in instead of saying that, it's kind of, it's and what is the sample size of this price
So this is
data set?
40,000 households which have been
40,000
there.
households, because India is so diverse according to region and according to the different community, but it's a good study and good
and
start.
then this could also be extended to other demographic characteristics, which is rural and urban.
Sure.
And then once we have the other data for the other financial year, then that could also be empaneled, and then it could be a panel data too.
Yeah, but the sociological reading we have to be a little more careful.
Sure.
Yes. Any other question?
Hi, good presentation. Some of the comments that I had was, in the last few slides when we were reporting the results, you were talking about high education, low education and all. And how about the other parameters? Did you consider the interdependencies? For example, if you are talking about education, are you also talking about education is one part? Whether they are affluent or urban or rural, that's another part. So I know this is from the price survey. So could you consider, or could you look at the other interdependency factors, or irrespective of that you looked at only the education? Irrespective of that you look at only the rich or affluent or poor households. How did you do that?
So ma'am, this is again only for the low educated, which is again considering both rural and urban. So everything else is constant, and for low educated means that the chief wage earner is less educated up to the primary level, keeping the other. But then this could also be interacted with in terms of the location also.
Okay. Okay.
Yeah, this could also be extended. Yes.
Thank you.
For sure.
Thanks.
So I have a question related to the ownership effect. So the lower income groups or the less educated groups that you take for comparison, they could probably have a lower level of ownership of these particular assets, right?
Yeah.
Does that actually impact the findings? The other group could have a higher level of ownership. Would the elasticity vary by ownership?
I'm not really sure of this, but then yeah, I'll think of it.
So
for sure.
my view, or the reason I asked is that those who generally tend to have a higher level of a particular asset, maybe they are willing to, for example, digital gold. That's probably more likely to be owned by the higher income group, and they are probably okay with reducing their consumption on that. Reducing their expenditure on that, versus the other group which may not have so much, but they don't change because they don't add or reduce. So lower elasticity. So there, my sense is there is a logic around this based on ownership.
Yeah. So I'll definitely look into it. This is one aspect here for sure. Okay.
Okay, yes, if there is no other question, then we can have the next speaker.
Okay. Thank you so much.
So Professor Priya Narayanan is the next speaker, please.
Thank you, Ms. Khandelwal. An academic with a long association with IIM Ahmedabad and IGPC as well, I invite Professor Priya Narayanan from IIM Kozhikode for her paper on gold retailing.
Hi everyone, thank you all for staying back for this last session of the day. So I would like to talk about jewellery companies, the jewellery industry. So let's look at this picture and get our thoughts started. So if you see on the left, towards the left, what we see is the typical big, large jewellery showroom. Looks like it's AC, lots of light, and that kind of a very large showroom. In the middle, towards the bottom, what you have is your mid-tier, mid-size kind of a jewellery outlet where you find these jewellery arrayed out and counters and people coming there and trying to buy products, but not so posh and not such a great ambience as the large ones. And towards the right, what you have is these one or two people running a small store and very small number of products and very, very small setup. Now, the interesting thing here is that we have all of these in India. So the market includes all these jewelers and many of these. So in terms of number of outlets, so we will see all that. The idea is that there are just so much variety. So, and the market is in transition. So where is this market going? How do we make sense of this? And hence, what kind of policy recommendations do we arrive at? So with this in mind, let's get started with today's presentation. It is about market orientation in India's evolving gold jewellery industry, implications for marketing and policy. So so there are two key research questions. One is on the nature of transition that is taking place in the gold jewelry market currently. And second is, because the market is in transition, it is likely that the different jewelers are facing different challenges. And these challenges are likely to be different for different players. So what are the strategies that they use? What could be the implications? So of course, acknowledgements before I get started. So Abdullah Fahad, NIT Calicut, he's supported with the first study, and Anupriya Ravichandran, she's currently with IIM Code, she's my academic associate. So she's supporting with the second piece of analysis. And of course, several interviews done over the years with jewelers, customers now. So all that has also helped in this project. So this market context, as I mentioned in the panel discussion as well, this market has been evolving quite a bit, and in recent years, maybe in the last 5-10 years, the evolution has been quite marked. So there is this, of course, we know the industry is big, the 700 tons and all that. The transition has been happening across consumer preferences. Consumers want lighter, lower weight fashion jewelry. They're ready to go for low carat jewelry. They want pieces which are more gem studded. They're ready to buy from digital channels, at least explore from digital channels. They want products which are fashionable. The companies themselves are changing, so the market is getting more organized, and I believe we heard about this from some others as well. And regulations are changing. In recent years, we have seen stronger hallmarking regulations and several other things. So the market as such is entirely changing. If any aspect you pick about the market, it's changing. At the same time, across jewelers, there are some similarities. In terms of pricing, it's still the weight of gold and then the making charges, discounts on making charges, the types of products, all these are still remaining the same. So let's try and get a sense of what exactly is the big picture. To get a sense of the big picture, I have applied the lens of market orientation. Market orientation is a theoretical lens that has been adopted since about the early 1990s. It looks at the extent to which a firm or a company is really adapting to the market. So market orientation typically consists of the extent to which the company imbibes customer data, that is, collects customer data, really disseminates it through all divisions in the company, not just marketing, and then responds to it. So this is a very formalized notion which the most ambitious and the most market responsive companies use. This is also linked to customer orientation, competitor orientation, and interfunctional collaboration. These are broadly the same things. Now this has been shown to be related to business performance in the market. The more market oriented you are, and it makes logical sense as well. In this, the firms can be really driving the markets, that's driving change, or the firms can be looking at what changes are happening in the market and follow those changes. So now let's try and apply this to the industry, in the gold jewelry industry. There are 3 main studies that are planned, of which the first 2 are broadly complete, the third one is ongoing. So the first study is meant to map how the industry is, that is in terms of what is the evolution, what are the kinds of players. This is done through secondary research, news articles, company websites, and a lot of secondary sources. There is no real database or anything which gives us a concrete data set of this sort, so some of this had to be built from scratch. The second part is about the marketing communication strategies, that is advertising and other forms of marketing communication used by the typical players in the industry, because that gives us a sense of their market orientation. So this was done through quantitative content analysis of YouTube ads. The third is about really figuring out the challenges and hence what strategies companies are adopting and hence what implications are there for jewelers and policymakers. This is to be done with interviews. So the findings from the first study is that there is a huge transition in the market. None of this, or probably most of this, is not new. A lot of this is quite known to us. At the same time, it is essential to really collect some data from the market and see how this transition is happening. So that is what we have really done in this piece of research. Collected a range of data from, I believe the sources were listed here. Okay, the number is not here, but probably the number would be close to 100, 150. The kind of articles, reports, all of that we have collected over time. across different sources. And what we see is that there is a huge demand for lightweight, use of technology. Both of these correspond to customers. The second finding is that there is a huge number of jewelers, yes, almost 200,000, but large companies hold 35% share. Branded jewelers rising, sub-brands, new companies, especially companies in the fashion category, and a lot of companies, especially the ones with high ambitions, trying to move beyond India, beyond to Middle East and the US. Government initiatives, of course, already mentioned. The types of jewelers, we have tried to classify types of jewelers because this is important in understanding their market orientation and in providing recommendations. So there are small, mid-sized and large jewelers. In mid-sized, and I have to thank Som for this, that listed and unlisted jewelers, after analyzing our data, we figured that we should actually consider them differently. So we actually have 4 types of jewelers, and their key characteristics are listed here, including the kind of features that they have, the product types and other businesses. Now, more interestingly for us, these 3 types of players actually have different types of challenges. They follow different strategies, different levels of market orientation, and the strength of their market orientation also varies. So if we take, just as an example, if we take the mid-sized are really interested in expanding beyond their geography. So very recently we saw P&G P&G Gadgil Jewelers trying to go into an IPO in order to expand and probably become pan-national or at least go beyond Maharashtra. So that is one strategy, one challenge that they are facing, and accordingly they are trying to explore exports, explore their diversify portfolio, grow their markets and so on. Their market type, that's market orientation type, has largely been on the responsive side. They are not yet shaping the market, they are not launching new trends, instead they are observing trends and following them. And finally, in terms of strength of Marcor, their Marcor is quite strong, they have the resources, they are able to raise investor funds, and they are able to follow through with their marketing orientation strategy. So this is quite different from that of small and large. The next study, we looked at YouTube videos. Like I mentioned, 111 YouTube videos were selected for about a period of 1 year till November 2024. 4 companies were selected. So 2 big companies where Tanishq is of course a national player, Senco is almost a national player but has a regional focus also, and Carrot Lane is now an established online player with retail outlets. Bluestone has just, it's probably the newest kid on the block and is trying to get itself established. So what we find is that through the analysis of the YouTube videos is that the views per subscriber, so we looked at their YouTube channels, the subscribers, it's the highest for Bluestone. They have a very strong digital strategy. They have very, very innovative products. Like I mentioned, the Hello Kitty kind of products. You should definitely take a look if you have not taken a look. And the likes per subscriber are not so strong. Unlike this, Carrot Lane likes are much stronger, telling us that they have a stronger, more loyal following among their subscribers. Senco and Tanishq probably do not target digital customers so much. They have a loyal customer base among those who are more of customers who prefer stores. We also find differences, and we have tabulated, and we have a much bigger data set on this. Differences in product type across several dimensions, differences in target segment again across different dimensions. So let me move on to the implications. One question that comes up is growth the only option? Because all the big names are trying to grow. In a way, they are competing against each other to grow. The issue with growth is that it's not for everybody, and it reduces margins also if you go for unconstrained growth. So the recommendation that I have come up with is that small jewelers probably are better off trying to standardize and trying to create new unique designs which only they can offer, because they can have certain karigars who do only that job. Mid-sized jewelers might wish to go for regional expansion, but brand building is critical, and differentiation is even more critical because large jewelers are going to come into their territory. And finally, for large jewelers, of course, they have to target their marketing efforts. I have an example here. So this is actually a web page where this is the Times of India page, and this is the kind of advertising that Kalyan did once, that's for Deepavali, last Deepavali, but not really sure what is the kind of impact you hope to get. Is it to popularize the brand name or what exactly? So you have to really target the marketing efforts because it eats on the margin. So raising profitability, it is a very key concern. In fact, Kalyan's profit margins is closer to 3%, the EBITDA margin. So that's probably not very sustainable in the long run. Tanishq, of course, is doing a better job at keeping its margins. So overall, this research, the contribution is, of course, extends the theory on market orientation. That's a research contribution. At the same time, it provides implications for jewelers, that's a practical implication, and policy support in terms of how to help these jewelers, particularly smaller jewelers, maintain their uniqueness. So this is where I will stop. Thank you all. Thank you.
Thank you, Professor Priya. Excellent presentation, lot of insights. Do we have any idea of the volume of business in the rural and urban, the trade? Is there any ballpark?
Right now, I don't have a figure. My sense, if I have to just take a ballpark, would be 60% in rural and 40 in urban, or thereabouts, maybe 70-30. So the largest share is still rural. That's my understanding. So not all of these would apply, but then the stores, I mean, the strategy for jewelers would still apply in these areas, regardless of whether they are rural or urban.
I would, but you know, there will be so much of regional difference.
Yes, regional differences would be there.
Like I have heard like from one of the manufacturers that for Bihar, they make different jewellery which is 4 carat. You know, people don't care about hallmarking, but if it's going into rural Bihar, then you have to show that the bride is covered with jewellery. So they don't want lightweight or... So I think there is, of course, this is very, very fascinating for the urban and the new generation. But we need to, you know, spread our tentacles in the other regional rural markets.
So I agree. That's possible that there are a lot of regional differences. So this research has attempted to take a big picture view. That is a top-down kind of view where we try to classify jewelers across India. Naturally, it is a very difficult task because they are just so heterogeneous. So that is probably the difficulty that we are also facing. But as we go towards implementation, definitely have to take into consideration these ground level insights, the differences, the nuanced differences across regions.
Sure. Yeah, it's open for questions.
Yeah, anybody over there behind? Anybody
Can't
asking
see
questions?
anybody. No.
So can I?
Yes, please.
Yeah. See, when you're talking about these small and big jewelers, right? Drawing from what we had listened to in the morning about informality of small jewelers, right? You know, informality is a strategy, and what the other speaker was telling about, you know, they just vanish or something like that. You know, I would, I don't know, in one of our another study that we have done recently, it's still, you know, it's in a case study format. We haven't put up formally on a public forum. And what I thought, or what I observed, is that the small jewelers are more into the B2B space and not into B2C. That's not a margin that they can sustain. The bigger jewelers are in a B2C, and smaller jewelers still are in a B2B space. Perhaps it could be as high as 90% of their business would be in B2B and 10% would be in B2C. And that is where they draw their margin from. And informality as a business strategy, it gives them a sense of protection from the vagaries of the system variabilities. That's what I understand. So this is my observation, not any specific question or something like that.
So that is something to be considered. The research,
it's
so
B2B.
Far, yes, got it. So far the research focused on the customer sales to customers. But you are right. If you are taking a jeweler perspective, you need to consider the B2B angle.
Yeah, and see, this also feeds either way. Because, you know, if you look at a big jeweler, one of the major limitations of a big jeweler is a good karigar at my rates, at my rates, and who is really skilled. And that is why I outsource to a smaller jeweler. right?
Yeah. So
Yeah.
that is definitely an issue. In
Yeah.
fact, the variety in the bigger jewelers tends to go down because you don't have unique karigars, unique skills of karigars.
Yeah. Thanks.
I have just one query which can't be probably answered through the study. I've always wondered why only these big jewelers have no products which are other luxury products. It's very strange for me. I mean, you go to any luxury shop, there is always one big luxury item, but they also keep others, even if it is small. You go to the big jackets, they will always keep a purse and leather and shoes. There'll be very few shoes. You go to Armani, it's a suit, but you also have this thing. Like that, I've seen it. Why is it that jewelers, maybe it has to be studied, have never thought of attracting customers even with anything else other than jewelry? Although they say sales is down, this is down, etc., but they just don't use their space so effectively. And the second one, obviously, is a study which we can keep doing, is why do you need so many designs? What's the cost of recycling them? I'm sure at least 20-30% goes for recycling. What's the cost of recycling? So it's just a comment, drawing from your market orientation, how do these big guys, because if many of them are getting listed, and I'm even surprised that the data on re-smelting is not reported. If I'm a shareholder, first thing I'll ask any of the jewelry firms is how much are you remelting? Why are you not putting it in the balance sheet? May not be this thing there. So these are the 2 or 3 comments I have. Maybe some study sometime to get an idea.
Yeah, the one on gold jewelers not selling anything else, I guess even the customer mindset is such that when you go to a store to buy gold, you are there only to buy gold. At max, you will, if you're going there to buy a chain or a necklace, you will consider earrings. So that could be.
See, one thing here, so if you go to a jeweler also, you see silver articles.
Yeah.
Silver is there.
Yeah, but it is either gold or silver.
In fact, some of these jewelers, the big names and all, they have also started keeping, apart from the light gold, some of them even keep this 1 gram kind of a thing in various size and formats. And when you're talking about the other part, recycling unsold, I think this is where the small jewelers suffer. They can't bear the holding cost. If you're a small jeweler, if you make some designs and if it can't be sold, they can't bear the holding cost, and they transfer it to the bigger one, right? And bigger ones, because they are bigger, perhaps they are able to observe it, or they are going to do something about EBITDA and all those things that Priya is saying. That's my observation.
Okay. Thank you. Definitely more points to think about.
Yeah.
Thank you.
Yeah.
Okay. All right. Thank you.
Thank you.
Now, for the next paper, I invite Ms. Shimoli Shah from IGPC itself and Professor Ritesh Patel from the Institute of Management, Nirma University, for their paper on the use of gold as a portfolio diversifier.
Good evening all. First of all, I would like to thank IGPC and Professor Sundaravali to give us this opportunity to present the paper. Also, my topic regarding my research paper is very much relevant to the morning session by our very own Chief Economic Advisor, Shri Anant Nageshwaran sir. He also talked about the impact of gold in a portfolio and how gold reacts during the geopolitical crisis. So, my research topic is gold as a portfolio diversifier and hedge for other assets. Evidence from the Russia-Ukraine war, Israel-Hamas war and Israel-Iran war. Okay, so there are 2 important words which have been used in my topic. First is the diversifier, second is the hedge. So, according to Bohr and Lucy, a hedge is an asset which is uncorrelated or negatively correlated with another asset, and a diversifier is an asset which is positively but not perfectly correlated with another asset or a portfolio on average. So, after the turmoil that COVID-19 created on the financial markets, and once it got over, as the markets were recovering, there were three main geopolitical crises which happened. First is Russia invaded Ukraine on Feb 2022, Israel-Hamas war on October 2023, and Israel-Iran war on April 2024. So we are considering all these three geopolitical crises in our study. Okay, basically what is the significance of the study? So whenever we measure an asset's financial capability, it is based on first its liquidity, second its response or fluctuation to other assets, and third its hedging potential. So we have heard a lot of discussion going around since morning regarding gold and its various aspects, and we definitely know that it is a important discussion for academicians as well as policymakers. So it is important that we study the impact of the crisis basically on analyzing the gold price dynamics. So here we are considering, we are identifying basically the connectedness of gold with a multiple asset classes, and also considering its role as a diversification and hedging tool during basically the market volatility period. We compare the pre-war crisis with the ongoing war crisis. Now there are existing studies or the past studies, there are studies which have studied the role of gold and vice versa, but they are still in its infancy. Talking about the motivation of the study, so how our study is different is basically that I already mentioned that we are studying the diversification and hedging characteristics of adding gold in numerous asset classes. Secondly, we have taken a wide array of asset classes with longer time frames, and hence the study is more comprehensive and broader. Also, it will have implications for portfolio managers and investors, and that is how that we have also calculated the optimal portfolio weights, the hedging effectiveness, the hedge ratios and the Sharpe ratios, which we will talk in our analysis part. Also, we have employed a very novel TVP VAR based extended joint connectedness method. Moving ahead towards the literature review. So what is the role of gold as a diversifier, safe haven and hedge? So we already are aware that base metals such as gold have been very important for a country's economic growth, stability. They boost GDP, and they are also have stock market, they're related to stock market reliability. Also, they impact the framework of international relations. Gold is an important store of value and a portfolio stabilizer during crisis, and it has been stated by very important researchers and authors, which I have already mentioned in the slides. So this is all their work which I am just implying here. So basically here there are multiple studies that have studied the role of gold against the various assets. But there are results which are contradictory also, where they say that silver is an exception rather than using gold for some assets. Also, some study says that aluminium can be a more safe haven asset during the COVID-19 pandemic, which is a contradictory to some of the existing studies. Also, why we have considered only geopolitical crisis? Because they have wider and more immediate economic repercussions than the other types of crisis, which has been stated in a very novel paper by Naeem. Also, connectedness of gold, there are multiple papers also on that. Existing studies are there, but there is also a dilemma in this, in which some say that gold acts as a receiver of shock from other markets, whereas some papers say that it is a transmitter of shock to other markets. So there are basically mixed results regarding the role of gold during the volatile situation. So here my study is basically to provide a clarity on this dilemma. Talking about the data and methodology part, so we have taken 4 panels. First is panel A, in which gold is related, connectedness of gold is calculated with silver, aluminium, crude oil and rice as commodities. In panel B, gold with Bitcoin, Ethereum, Binance Coin, Solana as cryptocurrency. For panel C, gold with 2 developed
stock markets, which is USA and UK, and 2 emerging stock markets, which is China and India. And in panel D, we have taken gold with 2 currency, which is Euro and USD, and with debt assets, which is US bond and Euro bond. The time duration is taken from Jan 2021 to October 2024, which is an extensive period. Daily data is taken, and it has been divided into 4 sample periods. First is the pre-war period, which is Jan 2021 to Feb 2022. Then the Russia-Ukraine war, which is from Feb 2022 to October 2024. Then the Israel-Hamas war, which is from October 2023 to October 2024, and Israel-Iran war, which is from April 2024 to October 2024. Now I would like to request Mr. Ritesh Patel, Professor, Nirma University, to continue with the analysis part of the research paper.
Thank you, Shimoli. Yeah, now moving ahead with the analysis presentations over there. So here the descriptive statistics shows the mean returns and standard deviation of all the assets. So the first value in the gold, it is a pre-war period. The second value, which is in the bracket, is a return during the Russia-Ukraine war period. The third bracket indicates the value which is reflected during Israel-Hamas war period, and the last is the value which is reflected during Israel-Iran war period. Okay, so here we observe that the mean returns is normally positive in majority cases. Standard deviations is keep on increasing in majority of the cases during the war period. That is indicating that the risk among the assets is being increased during the war period. The skewness and the excess kurtosis and Jack Barras justifies our normality conditions. ERS justifies our stationarity conditions, and Q1, Q2 justifies our conditionality conditions, which makes that the data is suitable for performing the further test. Moving ahead with an important component, correlations over there. So when we look about the correlations of gold, with aluminum, gold holds a positive correlation, but the degree is very low. So that reveals an insignificant correlations over there. With crude oil also, gold reveals almost negligible correlations. With rice, gold has sometimes a negative, sometimes a positive correlation, but the magnitude of correlation was very low. For silver, it is very, very important and serious matter, because silver and gold has all the period a very important correlations, more than 75%. Okay, that is a danger signal given to as investors over here only, because that will be reflected in our portfolio performance later on. So this is a gold price chart that I am shown it over here, and with the world timelines, it has also changed over there. So if you just see in the beginning of the 2021, that is a COVID period, the gold price was below $2,000. It remained below 2000 till even the Russia-Ukraine war, but later on it has increased and moved to $2,800. We took a data till October 7, 2024, otherwise present rate is $2,900+. So that you can see just in the last 2 years, that is 23-24, due to the war, the price of gold has constantly rise. A significant rise has been observed. This is the average dynamic connectedness over here. So we presented the dynamic connectedness with respect to 4 periods: pre-war period, during Russia-Ukraine war period, Israel-Hamas period, and that Israel period is coming in the next slide. So here in the pre-war period, you can see that the total connectedness among the assets is 30.96, that is 31%. That indicates that all these 4 commodities along with the golds in total link with each others by 31% over there. 31 is considered to be a low significant. Higher the level of the connectedness is coming from 100% as a result. Higher the level of connectedness, lower the diversification opportunity. So for an investor, lower the level of this particular connectedness is preferred. Here the assets plays either the transmitter or a receiver role. Okay. When the asset has a value which is greater than in the 2 side, that indicates a higher transmitter, where we can find that the aluminum and the crude oil are in the transmitter, where the gold, silver and rice, they are into the receiver roles. Normally what happens is whenever any such kind of crises or events occurs, the assets volatility is changing, because the assets is adversely getting impacted because of some news or certain actions which is taken at the global level. When the assets is impacted, definitely it will cause an impact to the neighboring assets or to the related assets over there. Okay, so here it is 31%. During Russia-Ukraine war also, it was a near around 31%, indicating not much impact of Russia-Ukraine war, maybe because at that time the COVID was also there. So world has witnessed that also, but the role of the assets has changed little bit over there. Okay. Moving to the next, it is an interesting to know that during Israel-Hamas war period, the connectedness increased to 34%, and during the Israel-Iran war, it has increased to 42%, reveals that during a crisis period, the assets comes together. This is also proven by Jankiram and Asjid in their studies. Then wherever there is a crisis, not only the war, but any financial crisis or any other, the markets comes closer to each other. Okay. Here also the assets keep on changing their roles. The only reason is the crisis. That was an average connectedness which was showing an average pictures, but we have also presented a dynamic total connectedness in order to capture the pictures of a various timelines over here. So here you can see that in the top in 2021 the connectedness level was high. Reason was COVID-19. Okay. However, later on it has came to the down. The reason was that on the 9th November 2020, 2 vaccines were trialed over there for COVID-19 and their success ratio was 90%. So world got one hope of ray of that will be able to get right of the COVID-19 soon. That's why the connectedness level decreased from near around 45 to around 30 over as a level. This remain in the stable over here. Before the world get out of COVID-19, Russia-Ukraine war started. That has escalated the connectedness and that has keep on increasing even in the 2023. But in 2023, suddenly it has fallen. The reason is there. On 5th May 2023, WHO has declared that COVID-19 is no more a pandemic. Okay, and then after, even during Israel-Hamas war, it has not increased because the world was out of the danger of the COVID-19. However, later on with the breakout of Israel-Iran war, the connectedness still started increasing because the world is not knowing what will happen tomorrow. We have measured the impact of the global factors on the connectedness. Okay, so here in the pre-war period, we have taken a certain factors. First is GEPU, that is Global Economic Policy Uncertainty. Second is GPR, Geopolitical Risk Index. OPU, that is Oil Price Index. TPU stands for Trade Price Index, and WUI stands for the World Uncertainty Index. The global economic policy uncertainty is because of COVID-19's wars. Countries are not able to take a final decisions on that. Geopolitical risk was there because obviously there was uncertainty to an entire Europe from the Russia side. Even oil price uncertainty was there because oil price keeps on fluctuated over there. Trade policy uncertainty was also prevailing, and world was uncertain during a pre-war period that what will happen in the COVID, whether we able to get a final solution of that or not. So during a pre-war period, we observe that the global economic policy uncertainty, trade policy uncertainty, and world uncertainty has a significant impact on the connectedness. During the Russia-Ukraine war, along with these three factors, geopolitical risk index has been added because we don't know that what will happen to Ukraine and what will happen to Europe. Entire world, entire continent is under a threat still also. However, during Israel-Hamas war and during Israel-Iran war, the only factor which was contributing significantly to the connectedness was GPR. Here it is interesting to note that both the TPU and WUI will not remain as a factor during Iran war periods. The reason is that because the world is free from the COVID-19 as declared by WHO. So that uncertainty level has decreased, and that's why GPR remain as a single main component which is increasing the connectedness. We propose a portfolio analysis over here using 6 different portfolio strategies. The purpose to use a different portfolio strategies because each and every investors are looking for a different expectations. So first is MVP, that is minimum variance portfolio, a strategy which gives you the lowest weightage over lowest risk on your portfolio. Here the gold weights is in a pre-war is 73% in portfolio, which is increased to 82 in during Russia-Ukraine war, and which falls further during both the Israel wars. Here the weights is decreasing through the method is indicating a portfolio rebalancing. The portfolio rebalancing is need to done because the returns of an asset is changing with the changing global dynamics. So at that time, when an investor change it over there, they are able to earn a desired Sharpe ratios and return over there. MCP stands for minimum correlation portfolio, that is giving a portfolio where the overall correlations among the assets is low, so there is a less impact of crisis or a risk. Okay, so it was 12% in pre-war period, but it has increased in all the 3 war periods. MCOP, minimum connectedness portfolio. Minimum connectedness portfolio has increased the weight from 13% to 16 and 22. Minimum connectedness portfolio gives us the lowest connectedness so that the connectedness can be minimized and their shocks can be minimized. The correlation gives us, it shows only the relationship between the 2 variables. As compared to that, connectedness portfolio shows us the spillover effects, that is the receiver or contributor effect over there, through which we are able to balance the portfolio. Next is EWP, equally weighted portfolio, which is called as naive diversification, which does not follow any protocol. It has only one protocol, that is weights divided by number of assets. So that's why it remained 20% across all the strategies. Then next we have a risk parity portfolio. Equal weighted portfolio equalize the weights, whereas risk parity portfolio equalize the risk. So it shows the weightage so that your all assets in your portfolio will contribute same amount of risk. And last and most important is maximum Sharpe portfolio, which gives us the maximum possible Sharpe, also known as optimal portfolios out of that. So here it is interesting to know that during a pre-war period, the gold weight was 0, because there was a reason, because aluminum has a high weighted at that time 64%, and at the same time the crude oil has a high weight. During a pre-war period, aluminum and crude oil both were earning a good return for the investors, but unfortunately during Russia-Ukraine war, their return shrink significantly and gold price rise. That's why the place of that two assets is taken away by gold up to a significant level over there. One of the reason is that Russia has been banned by trading in aluminum products over there, okay, and even in the crude oil. Okay, so that's why this two commodity has witnessed a downfall during that period. Moving to the next, Sharpe ratios. Sharpe ratio shows the return on a per amount of risk. Okay, so over here the minimum variance portfolio, if you just see as compared to pre-war period, in all the 3 war periods the Sharpe ratio is higher. Okay, whereas in case of minimum connectedness portfolio and minimum correlation and minimum connectedness, the Sharpe ratio is lower, which is indicating that investors should not use these two strategies for the diversification. In case of remaining 3 strategies, equally weighted, risk parity and maximum Sharpe, okay, only during Israel-Hamas war period the Sharpe ratio reveals high. Among all the strategies, the minimum variance portfolio remain as the base for the investors. The only reason for that is that minimum variance portfolio reduces the risk. It gives the portfolio which has the lowest possible risk over there, and during this war kind of uncertainty period, it becomes important for investor to minimize the risk as much as possible. Coming to the hedging analysis that we have, we propose a hedging analysis assets wise. So first we have the optimal weights that shows a 0.21, a percentage weightage is over there. That indicates that if you want to hedge a portfolio of $1, you're supposed to invest 21% of that $1 in aluminum and remaining 79% into gold. Second, we have a hedge ratio. Hedge ratio shows me 2 important points. The position of an asset should take it, and definitely whether it will give how much investment to be done in proportion to that. So here the hedge ratio is 0.38. That is a positive. That positive ratio indicates that first asset should take a long position. That is, if an investor go for buying the aluminum, he should go for sell of gold in a proportionately so that it can be managed. If investor is buying aluminum worth $1, they should sell the gold worth 0.38 percentage for 38 cents, so that they can investor able to manage the risk to the level. Last is hedge effectiveness. Hedge effectiveness should be more than 0. That shows that how much this hedging is effective against this particular kind of crisis period. So it shows a percentage out of 100. So obviously it is here not much satisfying results, because it is nominal percentage 6, 12 or 8 and 6. So not much results are revealed over there. It is interesting to know that for silver the weight is almost 0 and the hedge ratio is more than 1. This indicates that if you want to hedge silver, you have to over invest in a silver over there. Okay, the reason being that because silver is highly including investment with the normally
I think.
Yeah, I'll be taking 1 minute, ma'am, not more than. This is the finally conclusions we come to that. So other than this, we have evaluated the safe haven analysis. Okay, we have not reported, but over there we identify the utility of gold for a safe haven under minimum variance portfolio. And other than this Sharpe ratio, we have proposed a Kalmar ratio, Sterling ratio, Sortino ratios, which evaluates the portfolio only and only from the low return, that is negative return perspective. Sharpe ratio includes both positive and negative return, that is average return. Whereas these 3 ratios look after the returns which is below 0 and how gold is providing benefit to that. So gold holds a partial connectedness with all the assets, and that's why it giving the hedgings and diversification benefits to all the assets including safe haven. We have done an analysis for all the 4 panels, but in order to cover the limited presentations, we have presented only one portfolio, that is gold and commodity. Gold is giving highest benefit to equity portfolios, followed by debt and currency portfolio. Third is commodity, and then it comes to the cryptocurrency, because now Bitcoin is also viewed as one of the substitute of the golds. Okay, yeah. Thank you. Yes.
Thank you, Professor Ritesh and Ms. Shiroli. Is there any question, comments, clarification? So in that case, do we move to the next paper?
Yeah, we are thankful to the madam for providing opportunity. Yeah, thank you.
Thank you, Professor Patel and Shimoli. Now, joining us for the penultimate presentation of the day is Ms. Ilma Rizvi from IGPC itself. She is going to share her insights about the gold, gems and jewelry in India.
Oh, wonderful.
Thank you
Congratulations.
so much. Yes, ma'am. Thank you so much. Good evening, everyone. My presentation topic is, do Indian states spend similarly? A comparative study of jewelry, housing, and consumer goods. The presentation flow is as follows. We'll be discussing a basic introduction, then the empirical method, result, conclusion, and lastly, the policy implications. This is a brief introduction of the gems and jewelry industry. I might not be going into these details into the numbers and that we have been discussing so far from the whole day. So my idea of research is basically that I have been targeting to study the expenditure pattern at the state level in India, that how households are expending their source of income and the portfolio of basically a proportion of their income, how they are allocating to the gems and jewelry as against certain other consumer goods. So taking into consideration the paucity of data that we have seen, that we are not been coming across the state level data in the public domain. So we have targeted the consumer household survey data which CPHS and CMI is taking care of, and we have extracted the data from their database and clubbed it at the state level analysis. Then we have incorporated a model which is the convergence methodology. We use that to get into the final stage of our result, which gives us the state level club convergence approach, that what pattern these states are converging to, or what the transition path they have been following. So these are certain literature that we had gone through, and about all these consumer goods and the gems and jewelry factors that we have covered in the study. This is again a working paper, so your insights are most welcome, and this is just in the initial stage of the study. This is the model that I had discussed so far. We have taken into consideration the convergence analysis and the club clustering approach, which has been proposed by the Phillips and Soule in 2007. It covers the relative convergence strategy, which is different from the conventional method, beta and sigma convergence. It analyzes whether different groups converge to a common path or not. So basically, it takes into consideration the time transitional parameter, and it covers the heterogeneity factor very well. So that is what we came across. I have basically covered this model in terms of the food inflation, and taking insights from there, I have come up with this study that why not take this model and apply it in the domain of the gems and jewelry expenditure pattern. So the time period of study is monthly data from January 2015 till December 2019, and we have used the CMI database, and for the per capita NSDP data, we have extracted it from the India state. This is the log T regression that the model proposes, and these are the hypotheses for the study. Null hypothesis states that all the variables, or we can say the states that we are taking into consideration here, so these states follow a common transition path, that there is an overall convergence. However, the alternate hypothesis proposed that there is no overall convergence, and we definitely look into the club clustering approach. So for this study, we again reject the null hypothesis, and there are certain club convergence that is taking place. This is the tabular presentation of the results. The first column takes you to the initial club generation. This is a brief statistics, that how many samples we are considering, then out of those samples, what are these number of clubs that they have been generating. And based on the rejecting the null hypothesis that there is no overall convergence, we are taking into consideration the club merging test. And if that is being followed, then we are coming or driving our final result of the final club generation. And the last column of the table tells us about the speed of convergence, at what speed the states per se for the study takes into consideration to generate that particular club. These are for the different variables. So one variable is the gems and jewelry that I have mentioned. Another one is the artificial jewelry. Then for the per capita NSDP, and for the expenditure on housing, vehicle and clothing. So these collectively we are taking into consideration here. These are the core results that we have come across so far. So the first figure on the left shows the expenditure on gems and jewelry. So for this we have come up with the 3 clubs. This means that club 1, 2 and 3, and they follow a decreasing order of club generation, that is the states lying in club 1 have experienced the higher expenditure on the gems and jewelry sector, gems and jewelry as a commodity. Then likewise for the states clubbing into the club 2 have experienced a comparatively lower expenditure as against those which were in club 1. And likewise for the club 3 we have came across that these states in club 3 are following the least expenditure, and these are basically not visible because Goa and Puducherry are in this club so far. And the fourth one is the non-convergent category, that is they are not following any common path, they are into the divergent group. Similarly, for the right-hand side picture, we have this for the artificial jewelry. As against, we can see that for the gems and jewelry, which basically comprises of the gold, silver or diamond jewelry, they have the different approaches, and therefore they are the multiple clubs emerging out of those study, as against the expenditure pattern that has been followed in the artificial jewelry, because artificial jewelry is just the, we can say that new generation is taking that into consideration, and that is why Assam and Goa, they are into the non-convergent group here. Again, for the EMI for housing, these basically the similar pattern or the convergence into a one club basically shows that these commodities are taken up as a necessity item, and that is why they are just following a similar pattern as against those in the gems and jewelry sector, where they were following a transitional pattern because of the mindset and the cultural significance that the metal holds. Figure at the right is for the per capita net state domestic product. We have a multiple club convergence pattern here with the 7 clubs generating and a non-convergent group. 7 clubs here basically have this category with the southern states basically falling into a higher per capita income category, which definitely derives our sentiments there that southern states basically have this cultural significance where wedding and other festivals are being, other festivals have this gold jewelry as a core element there. So they have this higher income group, and then they have a higher expenditure on the jewelry too. These are for the clothing and the vehicle expenditure pattern. So basically, in the overall analysis so far, we have come across that the major states, that is Maharashtra, Gujarat, Madhya Pradesh, Tamil Nadu, Punjab and UP, they have experienced the higher expenditure pattern in for the gems and jewelry segment as against for the other commodities. Basically, these states have the highest clustering of the jewelry manufacturing units within the territory, and that is why northeastern states, which basically fall short of these facilities, they are experiencing a lowest expenditure in those segments. Most probably for all these categories, outliers are the Goa and Puducherry for the because they are following a tourism-based economy. They don't prefer jewelry as a priority element to fall there or to share the income pattern. And for Jammu and Kashmir, which is a non-convergent category for the gems and jewelry, we can simply state that it is most likely it follows the highest unrest pattern, and it is generally a baby state to take into consideration. So they have certain economic shocks. So that is why investment in jewelry is not a good option for them, and that is why their investment allocation, their income allocation is basically into the other consumer goods. Likewise for the Kerala, Bihar and other northeastern states, which have been outliers in their respective categories because of the pattern that they have been experiencing so far. For Bihar specifically, we have seen that the residents there are not expending their income for the expenditure for taking EMIs on the house loans. basically they are preferring for the migration and for certain job hunts and everything. So that might be a one reason so far. Based on that, we have derived these implications that supporting artisans and promoting MSMEs in the states can help us in deriving a higher expenditure in those states which haven't so far experienced a higher expenditure on the gems and jewelry, despite it being a core sector for the economy. Next, integration of the gems and jewelry market is another core element for the Indian segment or the Indian economy to focused upon. And overall, the focus of the government should, that I believe, is that it should be to reduce the income and consumption gap within the states to derive a symmetric pattern or at least an enhanced income share to the gems and jewelry as an element. Thank you. These are some of the references. Thank you so much.
Thank you, Dr. Ilma. That was very interesting. And I just want you to go back to the first map that you have shown. I'm a little confused about the role of Kerala.
I was thinking about that too.
Right.
Less than Tamil Nadu.
So how it can come in Club 2?
Specifically for Kerala, what we have been thinking and what our discussion so far has, we have been discussing this. It is more likely that Keralites basically prefer the UAE market for their investment location or for their income diversification. So they are not investing in the home state, rather mostly they are shifted, they are based out of UAE. So that is one approach that we can come across so far, that in Tamil Nadu we have the jewelry manufacturing hubs. So that is why people there are experiencing a higher income allocation to the gems and jewelry. Whereas in the Kerala, most of these population of that particular state is shifted, or they are the NRIs which are based in the UAE. So most likely it is one of the reasons that they have been investing in their market and not in the
But I think you need to cross-check this data with some other sources and see.
Surely, ma'am, surely.
Yeah. Right.
Yes,
Yes, yes.
Yeah, we talked about this, and it is just happened maybe last week sometime, right?
Yes,
so just before leaving, preparing for this conference. So we were thinking like perhaps Keralites buy jewelry more from the Gulf rather than from Kerala. We have to just check the numbers once again. It was and now Ilma, first and foremost, thanks very much for completing on time. And second is that, what about West Bengal? You are not even mentioning West Bengal. West Bengal, I thought they buy lots of jewelry.
They are in Club 1 for the gems and jewelry.
What is that?
Club 1, the highest expenditure category.
They are in the Club 1, okay.
Yes,
and how about this? Did you go for any, were you able to look at data, urban and rural or whatever?
Ma'am, that is still due. That is the one streamline that we are yet to follow. That we were planning to go into the rural-urban segments of these states individually, and then we can compare the overall scenario that what these states are proposing so far. So that is yet to be done, ma'am.
Right. Thanks.
Yeah, just a very good study. It's insightful, but as I said, it raised the query even for me. Just Kerala, how can it be? And the second one is, interestingly, you have compared so much. The two big data pieces which could help in whatever you have is gold loan market. Because that is available, although it may not be available freely. The number of branches giving gold loans, that will be a alibi for the quantum. The quantum of gold loans given by banks and NBFCs has just shot up now enormously. So if that can be mapped, and that's largely again south. It's not a north phenomenon, it's very south based. So that could help, maybe as some proxy for something. And the second thing is this MFI, microfinance. There is the Association for Microfinance, they put out a lot of information, and these are small loans. Against the gold demand, we could see, you can't do the whole of India because it's not available. Maybe if granular data is available about a particular state, you can probably see and draw some inferences about gold market there. If it is very high, very low, that gold loans market and then the gold market, maybe is there something they speak to each other? Will be a good idea. Because they are putting out a lot of data, MFIs and the gold loan market.
Definitely, sir. Thank you so much for your insights. I'll definitely incorporate these and we'll get over.
It may mean nothing, but maybe it tells you, because you are all statisticians, you can actually
Definitely,
find out
sir.
something in your research.
Definitely, sir. Thank you so much.
So is it easily accessible, this gold loan data?
I'm not sure the gold loan total is available, and you could take a lot of it is from South only, because it's put out by RBI itself, NBFCs and all. Otherwise, KPMG has issued some reports and all that stuff. But MFI data is available from the MFI Association. There are lots of companies. Just like how we do on gold, MFI is also a very, very opaque data market. But because it is used by banks, every bank which gives a loan to an MFI in any state, they always put out data. Enormous amount of data. This is the per capita, this is the size of the loan, this market is like this, the NPA is like this, etc. etc. We could draw.
Researchers should tap into that.
Absolutely.
Yes. Make a note.
And it is being used by licensed institutions, so it will have to have some validity in that.
Right.
Thank you so much.
Thank you, Dr. Ilma. And yeah, so the last presentation of the day is none other but the MC of the event. Yeah, please introduce.
I now invite our very own Dr. Aparna Raj to present her insightful research on India's gold policies. Aparna.
Good evening, everybody. It's been a long day and this is the last presentation. I'll not take more time. So my study, I've named it as the Golden Shackles, a cultural and economic paradox. So yes, so we have been discussing about this throughout and we have nothing more to say about gold. Gold is the donable asset that we have, a thing with a value of its own. It's a multifaceted asset with extreme connotations. If we say, we always talk about gold as something a little negative. It can be gold craze or gold hunger, not negative in that sense, but some words with negative connotations, like gold fever, being a gold digger, and so on. And we always, so if we actually look into gold, gold is maybe, I mean, given what the world is, gold is maybe the only asset to which a woman can claim agency to. We always talk of gold as something which is owned by a woman. So in that sense, gold is a little different. So it's a cultural and strategic asset. We have been talking about this since morning. It has religious value, tradition, it's ethnic, and it's also a celebratory and gifting artifact. So coming into what I'm going to talk about, I'm going to talk about the gold mobilization policies that India has been having since maybe the 1960s. So in 62, we had the gold policy coming out for the first time. And it said that India, as of now, as of 2016, it was said that Indian households hold 22,000 tons of gold, and this is lying idle somewhere. Going into that, a little bit more about what I am studying. I'm doing a multi-actor study to understand the policy process behind India's gold mobilization policies. So the objectives are to comprehend the role of physical gold in India, to analyze the policy processes behind the 3 major gold mobilization schemes, to recognize policy outcomes. So these are what I'm going to present today. It's a multi-actor study, as I've already mentioned. I'm going to talk about different stakeholders in gold, including banks, jewelers, refiners, and all of them. So here I'm going to only talk about a part of it, the customers. So my research questions that I'm trying to address through this presentation are, how have India's gold mobilization policies evolved over time? What are the policy outcomes of these schemes? So I have a little bit of a policy background, but this presentation is not going to be like that. So policy problem, if we look at the structure of any policy for that matter, the policy problem that made India, the country, look into gold, acts for gold, schemes for gold, was because we had an increase in CAD. And we also needed to conserve our forex deposits. So for that, the solutions that our government came out with are like curbing the gold imports that we had, which we are still talking about, and then mobilizing the individual gold holdings for that. So in 1965, we first came out with the Gold Control Act, followed by many, it was taken away in 68 because of its failure. We look into a few points of what made it fail. Then in 1999, we came back with the gold deposit scheme. And in 2015, a little bit of tweaking, we had the gold monetization scheme as well. So about the 22,000 to 30,000 tons that we talked about, the idle gold lying within India's households, if we look at the gold deposited to the banks over time, from 2017 till 2023, we just have had about 30 tons coming in. And these 30 tons have been put into three different deposit schemes usually, the short term, medium term and the long term. Short term was for 1 to 3 years, medium term for 5 to 7 years and the long term for 12 to 15 years. And all of them, the maximum interest rate was for the long term scheme, deposit, which was 2.5% and the medium had 2.25% and short term was left to the banks to decide how much should be given. So what happened to the Indian scenario? So the study, I started off with a survey and this was floated to around 1,000 respondents and I got a response rate of around 12%. And these are, I studied only the middle class in India, middle class including the upper middle class, like the population which has an income below 30 lakhs per annum. I did get people with more income as well, but the number of responses were 109 and I asked different questions for the profile of their assets, how much they knew about the markets and how they invested in various schemes. So in a snapshot, this was the responses I received, the people who had different types of occupation, what sector they were and income levels. So if you look at 80% of the people had some income below 30 lakhs. So that was fine to get some idea about the middle class. This is not a representative survey, I realize. So the major findings that I had were that the knowledge of financial markets was actually highest among the millennials for that matter, if we can say the millennials had the maximum knowledge about the markets. In the earlier one of the panels that we had, we did discuss about how the millennial preferences are also changing, of how they are looking into varieties, how they want more different channels of getting gold, etc. So beyond that, the maximum number of participants, 64% of the people in the age group 31 to 50 were the major market participant for the survey had. Among that, 72% had gold investments. So if we look at how the investors preferred gold, 37% of the people preferred to invest in gold ETFs and 89% preferred to invest in physical gold itself. So the reasons they cited for their preference to physical gold is that physical gold is more liquid. In terms of any emergency, they found that liquidating gold was much easier than anything else, because anything in the banks or even if it's in the banks, if it's a Sunday, then that liquidity is lost. You have an emergency. If it is outside the bank, then you can sell it at any point of time. And then they also said that gold had some sort of a sentimental attachment to it. If it has been handed down generations, people never preferred to sell it off, saying that it was given to me by my grandparents, or it's something that has been in my family over the years. And it's also, as we have seen, we already know that it's an appreciating asset as well. So people tend to hold and they just don't want to forgo it for the feeling that we are going to get more returns at a later date. And then I asked them about the gold monetization schemes and how much they knew about the gold GMS. So they said that only 14% said that they were aware of such schemes, just 14%, and 21% said that they had some vague recollection of the government saying this in 2015, but they did not want to put it into such schemes. So again, I asked them why they did not prefer the gold schemes if they had at least heard about such schemes. So 91% said that they don't want to put their gold into such gold monetization schemes. First and foremost, and the maximum number of responses that I got was that they were concerned over the wealth tax aspect of it. They were scared that the government was going to tax them if they went into some bank and said that I'm going to now deposit 50 grams of gold. Then because of that, they feared prosecution. Then obviously the fear of loss of liquidity, the sentimental attachment, and they considered 2.5% for a 12-year-old for a 12-year deficit to be very low because they were listening to 7.5 from the banks for a normal fixed deficit for the same span. So actually, one thing that they did not know was that if they did a very simple, even if they had just put in 10 grams of gold in 2015, it would have given them more than the double of it by the end of 7 years, like in a medium term. This thing. So looking medium-term deficit. So looking at the policy outcomes, if we see, so as I was saying, we had the Gold Act in 1965, which was withdrawn in 68. The main reason being that if we look at the act, it was something like the iron fist of the bureaucrats, which we usually say when we talk about Milton Friedman, not in this sense, but definitely it was like forcing Indian households to say how much they had in terms of gold. So the result of this policy was that we had a growing black market, widespread smuggling and corruption. Then when we look at the mobilization schemes like the gold deposit scheme and the gold monetization schemes of 1999 and 2015, both of them, they are not much different. So we had low participation rates, and based on the data that we have, we found that less than 0.5% of the gold returned to the system that we have. So looking at how the policy performed from the survey perspective, the schemes had low uptake despite its high potential. So the major key barriers were like the liquidity concerns, wealth tax and prosecution which followed that, and the mirage of low returns. It was not that the returns were low, but then the investors had this thing in their mind that 2.5 is a very low percentage of returns. Then when we look at it, we had the operational inefficiencies, because the monetization scheme said that you give your gold to us, we'll take it, we'll sort of look at how much pure gold we have in that, and within 30 days we'll give you the amount of deposit it has. So this problem, this long valuation delay also caused a sort of thing in the minds of the investors that we should not be putting our gold into the deposit schemes. And there were also the engagement with the collection and purity testing centers were also a little bit tedious. Even if we look at it from the perspective of the banks, they would have had to incur more money in sort of getting all these things done. So reimagining this policy, as of now, the study is in its initial stages. It's like creating better awareness among the market players, and among the customers itself. So it's like it's looking like a missing link in the gold monetization schemes. So we have to have nationwide financial literacy campaigns, which can include advertising, celebrity and influencer endorsements, and simplified messaging, sort of making people understand how much it can help you to even give the idle gold that we have in terms of, well, okay, we say about attachment towards jewelry, but what about coins or something, some scrap gold that we might have which we are not going to use ever. So let them put that into the banks. That can also actually help us getting back to the so said 22,000 tons of idle gold in the country. Then about the policy penetration, how we can break through the structural barriers that we have. So as we can see, and especially for the short-term deposits, the banks are not much interested, and they are fixing their own interest rates. And we could see from the graph as well that short-term deposits are pretty low. So we have limited bank engagement because of the fact that it's operationally a little expensive and maybe financially unviable for the banks, but we don't, I have to collect data from the bank's perspective as well. Then the government, so maybe the government can give more incentives to the banks so that they can also support this sort of a scheme. They can, and then we can sort of try to integrate it with some digital finance apps, and obviously the jewelers can also become financial partners so that we can make this scheme successful. So I am ending the presentation, and we are at the end of our first day of conference as well.
Thank you. Yeah, thank you, Aparna. It's an interesting paper, and I can understand it's a work in progress. You will be doing more work. One small error, Gold Control Act is 1968. So 1965, the bill was introduced.
Bill came, so I kept it.
No, but that underwent a lot of changes. It came in 1968. Yes, and that history is also very important. Like they repealed the 14-Carat Act. So what was repealed, what was not repealed. So because you're working on policy, I thought I'll draw your attention.
Yes.
And from the bank's perspective, it's very interesting. And I spoke to an SBI manager once, And he said that if you have a gold bond, the paper gold, then it can be in like the bride's name, right? Otherwise, the jewelry will be taken by the parents-in-law, by the mother-in-law, and it's for the family. So we have to, for the Indian audience, that kind of, I think, appeal, it can work. But how the gold functions really in an Indian household, as you said, the fungibility and the ease of it all. So this is a very fascinating, interesting research. So I ask audience if you have.
Yeah, I have a comment actually.
Right.
Being an ex-banker, I know what the failures are as far as the gold monetization scheme is concerned. Now it was renamed as gold monetization scheme. Earlier it was gold deposit scheme. The problem where is that it continued with deposit rather than focusing on even a buyback. So a bank, instead of having the operational cost of running the account of a deposit, they could have actually bought back that gold from the customer. Now it could not be jewelry because banks will never accept the jewelry part. They will accept bars or coins because that is more easier for them to melt. If you're going for a jewelry melting, you lose the wastage and everything will be there and nothing will be actually, you will not get anything. You will not get the interest that is being given compared to the wastage that is going. It doesn't make sense.
Right.
So the banks would have been more interested on the bullion bars and the coins, which may have been actually been sold to them earlier by the same banks. And it's easily possible to trace those materials because all this database is already with them. So they could have actually bought back those directly instead of taking a deposit. So monetization could have happened actually. So they, instead of importing from the markets, they would have actually purchased it locally, hedged it across and again recirculated that in the domestic markets.
Two things very quickly, you can, since you're doing the study, you're not going to stop people from buying gold, but you can change the way they buy gold so that it can be monetized. One of the things is obviously digital gold you have covered. Other thing is, we said somewhere that the Indian gold coin was launched along with sovereign gold bonds. People have forgotten that. The whole idea was the gold coin becomes the most standard coin in gold in India. Standard of gold in India. So I have 10 grams of sealed Indian gold coin. I can actually go and give this 10 grams. Nobody needs to melt it because I know it's the government of India approved, and I can ask for a 10-gram jewelry. And that person can go and give it to the bank, and then the bank can give 10 grams of new gold. So the whole idea is by bringing standardized gold like American Eagle or all those brands. One is people will hoard it, investors also. Second is you can actually monetize the gold because I am not going to. After you have sold, let's take you sell 500 tons. 500 tons becomes actually self-circulating. It will not come out. You don't need cash. So that is the other way of monetizing gold. The third one is very clearly, we have to look at, apart from the tax issues and all, nobody will monetize the gold if you are only one way. The fear of tax is one. The other fear I have is there is a guy who only takes gold from me, right? He'll never give me gold if I want. That is also the reason why we sell the gold coins through the banks, because then I feel I can go into a bank, I can buy a gold coin, I can also deposit my gold. So study these. There are lots of data. I'm very happy to help you, all around people, because somebody has to just put everything together. There is also something done by the Refiners Association. I can send it to you because it is important to bring this. The fear is not only about the gold thing. And when you are writing this paper, also introduce, there is no fear when you go to a bank and give gold as a collateral. But suddenly the fear comes when you go to the bank and give a deposit. Why is that? I have never been able to figure out what is the psychology here. I go and I give gold, and gold loans are also 5 lakhs and all comes in now. Nobody asks the question. Nobody worries about it. Is it because they are taking a loan? In which case, bring all the gold deposit schemes through as a loan against mortgages or whatever it is, upfront payment against mortgages or something. I have never figured, because ultimately gold is gold. When I take gold to the bank, why were they not borrow? Why did we not worry that the same taxman will come after me? And none of these bank gold, I can tell you, is backed by invoice or anything. No bank asks you what is the invoice. They only do the traditional way of checking. That's again is something very interesting to study. I'll leave it to you.
One more adding to what Som has been talking about, retailing of gold coins. Now, under the short-term bank deposit scheme, the interest rates offered might be somewhere around 50 basis to maybe around 1.2%. That was, at that point of time, that was the probable range. Because the banks, and not many banks were active. Maybe State Bank of India was active, maybe Bank of Nova Scotia at that point of time was active. And what they could have done is, they could have actually retailed or made those whatever deposits they got, made it into smaller coins and sold it in the market with an option to buy back again. So what essentially happens is that these retail coins, generally the spreads in terms of the pricing that is happening for sales is approximately more than 2%. So what they give it to the depositor is 1.2%, but what they get in return from the retail person who is actually buying is approximately 2%. So 80 basis they already got it. And plus the factor is that they have this STBD for at least 3 years. So every time they sell it, they probably hedge it, then they will again procure some gold from outside based on this deposit, again sell it. So every time you have this turnaround of that 2% happening. So they earn on that. So that's one more thing which actually did not take off. Many banks actually requested that they be allowed to retail the gold coins based on these deposits, and that was also not permitted.
So lots of thoughts.
One small addition to what Som was saying and what Ramki. This is something that I was talking very recently. When you talk about this gold deposit or gold monetization scheme, we have to look at multiple other factors also. What is the kind of target customers that we are looking at in the socio-economic strata? Very poor, middle income, upper middle class, or higher income group. The very low strata are not going to come in there because they don't have anything to dispose. And when you look at the lower middle class or the upper middle class or the really richer affluent class, the other question comes in, when it comes to keeping the gold for a loan or something, I know for sure that this gold I'm going to get it back. Here the problem is, if I'm going to give it as a gold deposit scheme or a gold monetization scheme, with that money or with this money that I'm going to get, what am I going to do with this? That is not there. And the second part is that if gold is a safe haven for every household, even if I'm going to get it, I have to replace it by some other gold and I have to have it. So that behavior thing is, again, we have to do it with lots of data, and I think we'll let it.
Rajesh Khosla and I worked on one idea. Again, put it out, but now that you are studying it, what we said is at least 80% of jewelry is standard designs, say 60%. We are not looking at the entire universe as well. We are looking at a small piece. The standard jewelry, can it be melted? But we promise the customer, we take a 3D picture and all that. We promise the customer when you come back, it must be 3 or 5 years, I'll give you the same jewelry back. That way what I will do as a government is I'll melt it, but I got to give the same thing back. Now, same does not mean exactly everybody is there, but you could even do that because now you have the technology. There will be an additional cost, making charges. Factor it into the whole deposit cost. People will probably line up. Because I'll say, okay, give my chain for 5 years, you're getting 1% also, and I'll give you the chain back. That would also work. Now, is there a way? I think it can be. So, with that, I will stop because we have had a long day.
Thank you very much.
Thank you very much.
Thank you for your feedback.
Thank you, Dr. Aparna. Yeah.
So, as we mark the end of a long day of keynotes, panel discussions, and paper presentations, let us hope that these conversations spark new ideas and opportunities for the industry. I invite Professor Sundaravali to felicitate our session chair.